Hello and welcome to this episode of the GRC Red Flag Series, brought to you by GRC World Forums and GRC 2020 Research. And I'm Michael Rasmussen, your host, analyst, and GRC pundit. The GRC Red Flag Series takes place every month with a focus to identify, debate, discuss, and interact on the current and future critical risks and regulatory changes and developments that impact your organization. I'm pleased to be hosting this sixth edition of the GRC Red Flag Series. If you missed the previous episodes, don't worry, you can catch up on them on demand by visiting the on-demand section on the left-hand side of the site. In today's episode of the GRC Red Flag Series, we're looking at aligning risk and performance management. As ever, we have a fantastic edition ahead of us, and we will be joined by many esteemed guests, including Tor, the CEO of Corporator, Karl Magnus, Country Manager of Germany for Corporator, Sonka, the Vice President in Group Risk Governance at Deutsche Telekom, and Brad, the Vice President of Americas at Corporator. I'd like to take a moment to thank our sponsor, Corporator. Corporator can digitally model their customers, your organization's business management system to provide a holistic, central point of governance, management, and assurance of the corporation's performance, risk, and compliance. Using Corporation, organizations can align business objectives with risk and compliance strategies and move away from old legacy internal reporting to modern transparency by enabling information flow both horizontally and vertically within the organization. To get started, we'll be having a conversation with Tor, the CEO of Corporator, coming up next. Hi, and welcome to our conversation with Tor, the CEO of Corporator. Before I invite Tor on, I'd like to give you a bit of background. Having lived through the effects of IT-controlled performance management solutions, Tor had a vision to create software that could be run by business users. He founded Corporator in 2000, 21 years back. Corporator's product development portfolio receives Tor's direct attention. One of the key reasons why product development Corporator is run by business users, not the back bowels of IT, but the business users. Social responsibility is another area of interest to Tor. He is instrumental in several community development initiatives in Norway and elsewhere. The main focus of these initiatives is to offer sustainable solutions for people and communities and to bring back hope and life. We are thrilled to have you joining us, Tor.
Yeah, it's a pleasure to be here, Michael. Thanks.
Now, you and we have regular conversations, nearly monthly, and on interacting on the challenges organizations face, because there's so often a disconnect between risk management, often in the bowels and depths of the organization, and performance management, which was really directed from the top. So let's just start off our conversation today. What are the top concerns and challenges of the board and executives that you see within your clients?
That's a good question, Michael, and I don't think there is a clear answer for everybody, that one answer fits everybody. So this will vary from business to business, what type of business you're in, company size, if it's private and public. And there is also a big variety on the country and region you operate in. So it varies around the world. And it also varies from time to time, ref the pandemic that we are a part of now. So I think the pandemic, it's still a concern for many companies today. But if I should kind of put this or give an answer to what you were asking about, I would probably do two bulks. One thing that are on the top concern of boards and executives today is are we actually bringing our company forward in the right direction? Are we doing the good stuff? Like, are we maximizing the potential as a company? That has to do with performance, effectiveness, efficiency, and are we actually creating substantial value? And this is also often measured against our competitors. Are we beating our competitors? Are we actually perceived better than our competitors? So this positive reputation management is also a big thing of businesses today. How do we look and appear internally, externally, towards the stock market as well? And also, are we discovering the opportunities? Do we see the trends? Do we have the right strategy? And are we also able to execute on strategy? So survey shows that 9 out of 10 companies fails to execute on strategy. So it's a major concern. And of course, it's all coming down to prioritization. And are we aligned with the company strategy? And do we have a strategy? So these are the core good things. And then we have the bad things, where a lot of risk management comes in. It's a lot of the fears that companies has now. I spoke to Carl in Germany, and he said one of the biggest fears in Germany is my company go bankrupt. So bankruptcy, how to avoid bankrupt, avoid scandal, the reputation management. People are afraid being blamed, become the scapegoat. And boards just want to be held blameless of what's happening. So the whole area of compliance, risk management, governance is key for boards and executives around the world. So one other thing we also see is that earlier companies were kept responsible for being compliant, but with the new regulations like individual accountability regimes, etc., the compliance responsibility to comply is put towards individuals and not only companies. So it's a big change. And it's if you summarize it, it's actually in 2 brackets. Are we doing the good stuff that brings the company forward? And are we making sure the bad things that should not happen doesn't happen? So for us as a tech company, Michael, if I can talk more about what we are thinking about and our management and board, we talk about raising money, how much should we raise, growth, raising money versus organic growth. When you're a tech company, it's also about agility. How fast can you move? How fast can we turn the ship? We are also very occupied in market intelligence, detection system, run scenarios. So it's actually a belief system about the future, what will happen in the future. And you just try to position your business in the best way to do this. I have 2 more things like talent, talent retention, getting the right talent. Is also a key, and also culture and values. That is very important for us. So if you come with the wrong values, you don't get the job in corporate. So these are the things that I think are some are generic, some are specific. It's about doing the good, bring the company forward, avoiding the bad things, the things that should not happen to your company.
What amazes me there, Tor, is how what you find aligns so well with what I see in the market for organizations and what they're trying to achieve. And so in that context, I mean, you talk about performance, you talk about risk and all these, values and in all these different areas. I bring that down to 3 themes. One is the integrity of the organization, particularly in the context of ESG, environmental social governance, but really about the values of the organization. What we communicate to the world, is it smoke and mirrors and pretending, or is it reality in the organization? Integrity, fits right into what you just described. The other thing that strikes me in what you just described is resiliency. How do we be resilient, particularly coming out of the pandemic? And that has to have a performance focus as well as a risk management focus, and bringing those together to be a resilient organization. But that resiliency is the ability to spring back from event, to be able to recover. So, I mean, if you're running and you trip, how quickly can you get up and get back going? I say that organizations are also now looking at how do we go beyond resiliency to be agile. We have everything coming at us from so many directions, from new regulations to risk to the changing business environment and performance and strategy. How do we enable agility as well? So if I had to take everything that you stated, it wraps up in those 3 themes that I'm focusing on in my research in 2022, the integrity, the resiliency, but also how do we go beyond resilience to agility in the organization?
Yeah, then we are talking to the same guys, Michael.
Yep.
Yes, good.
So the big question before us today, what is risk and what is risk management? I started my career nearly 30 years ago, 28 years ago. And in the 90s, my career was focused on IT security. And I've gone well beyond that. I got my law degree. I focus on a lot of corporate compliance, ethics, and the role of corporate secretary, and so many other things. But back when I started my career, it was about IT risks, and IT risks are still a huge issue. But it's something you don't want, and so it was like risk is seen as a hazard and harm. But so often we see that risk is something more than that. The U.S. President Teddy Roosevelt, over 100 years ago, he said, "Risk is like fire. If controlled, it will help you. If uncontrolled, it will rise up and destroy you." Risk is a tool for the organization, and that's how some look at this as well. So my question for you: what is risk, and what is risk management? If you're going to educate organizations out there, how should they be thinking about risk and risk management?
Yeah, it's a good question again, Michael, and I'm sure you have an answer to it as well, and a definition. But I googled yesterday and said, well, what is risk management? And what comes up there is like 10 definition of risk management, and you have so many varieties, and so it depends who you ask. And if you ask me, I like this definition: risk is the possibility to lose something of value. And I know that's kind of how I define risk, Michael. I know that it has the word possibility, so there is an uncertainty around this. There is a negative connotation around this as well, lose. And then you have the word value. So it all comes down to what is value. And I know that a lot of core risk people will say risk management is also looking at creating value. Like you said, the fire can be used for something good. And I'm also okay with that. That's kind of the flip side of risk, which is the opportunity, and that is also good. But to say, I just see some core kind of, can I say, fanatic risk guys, Michael? They kind of put themselves in the center of businesses and say, we are the business. We don't only deal with uncertainty and kind of this loss of value, but we're also the opportunity guys, and to a certain extent, there are opportunities that you can also look at on the risk management side. But there are so many other functions that are focusing on, business development, strategy development, making sure that we are kind of using the fire for the good, as you said, Michael. So don't see the risk tool set as the only tool to create this value or to use the fire, because there are a lot of fire brigades and people that are cooking food on this fire, and don't just keep that within the risk tool. So if you see what I mean. So yeah.
I certainly do. And aligning with your focus, but a little bit different perspective, is ISO 31000, which defines risk as the effect of uncertainty on objectives. And if you define risk as uncertainty, it can have a negative downstream impact, the hazard and harm that you're talking about. But risk also can have a positive upside too, in risk taking on the opportunity side. And there's that. I think if we have a risk, there's always a possibility of loss, but there's also a focus on reward and return for taking risk as well.
I know, but if you really would like to win the hearts and the mind of the organization, Michael, if you look at some of these kind of encyclopedia and what they define risk, it's always negative. But first you have to unlearn in order to learn the organization. If you have this wider kind of perception of risk, which is okay, I'm okay with that. But there needs to be a language, there needs to be an understanding, there needs to be a boundary of how long or how far the risk management function or tool set goes, and making sure that all business areas like strategy, HR, finance, project operations, market, sales, customer, whatever, they are all kind of a part of the risk universe, and they can use the tool set, as you say, and that's what the risk function should do: use the tool set as risk is, and also look at the upside of this as well. So yeah, for me, risk management is also about communication, and it's about winning the hearts and the mind of the functional heads, so that the businesses can also deal with the domain of risk management. And if I can just say what I like with one of the panelists today, Sunke Thun from Deutsche Telekom. He has on his LinkedIn profile, everyone is a risk manager. And I think risk managers are all over. I'm a risk manager as the CEO of corporate. You are a risk manager. Everybody deals with risk. So yeah, was that an okay answer, Michael?
That's a great answer. And I think the common agreement is there wouldn't be a risk if there wasn't a downside, a negative side. Yeah. We wouldn't have the word risk if there wasn't some type of negative side to it. But in some areas, there might be a positive upside to taking risk as well. And whether we call that risk or something else, that could be a discussion. But risk does involve some type of downside, hazard, or harm, or uncertainty, or loss from that perspective. So getting to that, we have a lot of acronyms out there. Of course, I love GRC. This is the GRC Red Flag Series, Governance, Risk, and Compliance. We have ERM, Enterprise Risk Management, which by my definition is the R in GRC. And we have ORM, Operational Risk Management. And of course, you got IRM now and all these things. How do you differentiate these terms, particularly ERM and ORM?
So for me, again, I'm just talking about my interpretation and my understanding of this, Michael. So it's just risk at different levels, and it's all connected. So the relationship, it's ERM and ORM are connected. And similar, if I can just make a similarity to performance management, you can go from the strategic objectives, start and map out the indicators, and sometimes we create what we call strategy maps and value driver maps. And from the strategic to the operational level, we kind of link it all together in the performance space. So you can have strategic KPIs, operational KPIs, and actually describe the story of how you achieve the overall objectives down in the operations as well. Similar on the risk side, ERM is connected to your strategic objectives, and it all connects as well to the operational level. So I just feel that Southwest Airlines, for example, if you Google it, say, and you write strategy map example, you can see how the performance story is built up with these objectives, KPIs, initiatives, targets. And there you can also start adding risk management, enterprise risk factors, risk treatment plans, etc. And you can do that from the strategic to the operational. It fits, as the performance story fits, the risk story fits with ERM and ORM.
Yep. And so from the way I've looked at it, which is very similar, ERM is sort of that top-down alignment. And I'm using this by my semantics and definitions because you'll see people out there that use these terms interchangeably or differently. But to me, ERM is that top-down focus of the organization on the strategy, performance, and objectives. And then the ORM, operational risk, is that bottoms up, down in the weeds. And risk management is bringing all these together. ERM from the top down, ORM from the bowels and processes of the organization. And good risk management is going to bring both these together.
True. I follow you.
So why is risk so often disconnected from performance, strategy, and objective management?
I think it has to do with the way things are organized. You have a head of risk or a risk director or whatever, and in a way you put a function to the person or to the organization. So if everyone is a risk manager, I think we need to think in the terms of the dimensions of risk. And it needs to be a part of the organization daily life, so to say. So, that's what I think. People that work with performance management, they are kind of solely in the performance management space. People in risk are kind of working in their silo. So, yeah. We just need to break the silos and get a common way of talking about risk, discussing risk, and also contextualizing risk, because risk is always in the context.
And I completely agree. And for me, if we talk about the 3 lines model, which you got the first line, which is defined by as operational management. But I say it's always all the way to the frontline employee as well. You've got the second line being risk managers, and then the third line being audit and assurance roles. And in that context, historically, we've had a lot of focus on the second and third line of risk management. But really, we need to be able to engage the first line. I can think of a large financial services firm that I've been interacting with out of their London, the United Kingdom branch of it. And they actually use Corporator. But one of their key things is they restructure their enterprise risk management program. Is not only do we need the depths of analytics and understanding of risk for second line functions, but we need to really be able to engage the first line operational management on their risk responsibilities and accountabilities, because at the end of the day, the back office of risk management is there to facilitate risk discussions, but it's really the business that owns and takes risk.
That's it. And then it's a question of, do you have the arena to meet and discuss? And do you have the context described in a way where you can actually facilitate those discussions? So, and I think it has a lot to do with communication, how we behave, that we don't come as kind of these proud guys that knows much more than everybody else, but come a bit humble and more have a good discussion and give them some empathy of what the situation they are in, Michael, because again, it's about winning the hearts and the minds, so they will actually work with you. Think of these dimension of risk management, performance, etc.
So I guess the question before us today is, what does good risk management look like? If you had one of your clients or prospects coming to Corporator and saying, well, what should we do here? Well, what does good risk management look like? How would you design it and define it for them?
Yeah, it's a good question again. First of all, Michael, if I kind of stick to my definition of risk, it's about the possibility of losing something of value. It's kind of defining what is value and how much is value worth, and how can you lose this, or how can you kind of lose the value, and also what can you do? So I think. Instead of using all these advanced acronyms, Michael, if people don't understand it, either you have to teach it or you have to dress it up in a more daily, language, maybe. I think from a risk management perspective, it's about facilitation, as you said. It's about good communication, and I think it's important that risk manager is just there to facilitate. It's a tool. It's a dialogue tool, and it's all about mapping up all these things, connecting the dots, because in a business everything is connected with everything. So that's what I think.
Yeah. So the way I describe it to organizations is everybody's doing risk management today. And as you mentioned, and even in Sonka's LinkedIn profile, everybody's a risk manager. And so you're not going to find an organization that just says we do not manage risk. To me, it's a maturity spectrum. Are you in this ad hoc reactive firefighting mode where you're putting out fires of risk as they arise? Are you more strong on the back office of risk management, but there's breaking down in the front office and the accountability of risk, more in that middle maturity? Or are you at this agile level of maturity that really integrates risk into strategy, performance, objective management of the organization? And risk has become, the back office is more of a facilitation role, in the front office and executives, they really own and understand risk in context. So my question then is, how do we integrate strategy, performance, and risk management?
First of all, I think risk management without the context is just blah, blah, blah. It's nothing. The same with performance management. Without the context, is just reporting. So kind of coming up with this business context, which strategy is probably the highest level of a business context, is the story, where you are as a company today, where you would like to go as a company, and also the path and the steps you take on the journey towards your strategic destination. So all disciplines are involved in strategy, and if you just look at finance, HR, portfolio, quality, risk, strategy, business development, IT, sales, operation, processes, it's kind of all these facets of business can actually work together and say, if we are here today, if we should achieve this in our strategy, how do we do this? And start talk and elaborate about this. So we believe very much to create this, what we call a digital twin of your organization. We actually give space for the business functions to actually be a part and articulate this. So I think having this way of contextualizing and describing, the organization, the strategy, the journey that you should take, the risks that are arising here, around the objectives, around, the objectives, processes, operations, supply chain, customer, we can put performance of the processes, performance of operation, etc. But we can also put risk. So it's kind of the just another perspective of the whole thing. So I think creating this digital twin, putting the context where you can actually hook up the risk, the opportunities, the performance, the projects, the talents, etc. So I think it's kind of having this common place, arena to kind of work together and break the silos.
Excellent. A lot of this reminds me of a conversation I had with Brad Jewett about 15 years ago, maybe a little under 15 years ago. But at the time, he was the enterprise risk manager at Microsoft. And he had this whole approach called the rhythm of risk. And what he did is, every year I can plan on these cyclical risk assessments that have to be done, more checkbox things. But he had a whole set of his resources that was dedicated to the strategic. And with that, he would sit down with each manager and executive and go through their strategic objectives, quarterly and yearly, and then build out a risk profile for each of those objectives and help them monitor key risk indicators and metrics aligned with the objectives of the board, executives, and operational management. But then he also would actually monitor the agenda on like board and executive calendars and have resources that would give contextually relevant risk information for whatever was actually on their agenda. So if they're going to talk about expanding operations in China or something, they had risk information specifically to that agenda item. Your answer to the question there sort of struck a chord with in my discussion with Brad Jewett when he was at Microsoft 15 years ago.
No, I think that's the right way to do it,
Yeah, excellent. So with that, we do have an audience question here. How important is managing key risk indicators today?
I think the whole indicator is more kind of, as the word indication says, like with doctors, something is wrong. You can kind of prove these things in the organization. So it's kind of putting a diagnose to your organization about your risks. But I'm always this kind of guy that would say it's better to do the right things than to measure the right things, if I should put one above the other things. But of course, key risk indicators are vital. It gives you the indication. So yeah, definitely. Like a KPI is also indicating how your performance is. The key risk indicators are actually saying something about your risk and how well you are doing.
In that context, key risk indicators don't happen in a vacuum. They happen in what we're discussing in strategy, performance, and objectives. So we have key performance indicators for our performance. To me, key risk indicators should align with those key performance indicators. What are the risks that we're monitoring that can actually hinder and impact that performance item?
True. And that's the kind of the whole context story that I'm kind of so strong on, Michael, because I've just seen so many risk projects. They kind of live in their silos, and then they say, oh, we need to find some strategic objectives, and then they find some documents and try to kind of say, oh, here are some strategic objectives. So it's kind of isolated. It's done beside the whole business. So I'm just saying, get together, find the story, find the context, start speak to each other, define the whole management system, which the risk management is a part of, like performance management, strategy management, etc.
Excellent. Well, we're at the top of our half hour, which means we need to bring on our panelists. Hello, and welcome back to our panel discussion. Alongside Tor, we now have Carl, the country manager of Business Operator, Sonka, the vice president of risk governance at Deutsche Telekom, and Brad, the vice president of Americas Incorporator. To give you a bit of a background on our panelists, Carl Magnus studied business administration with a focus on organizational design and strategy at the University of Stavanger. He has focused on the digital transformation of management functions for most of his career. With a passion for travel and international business, he has worked across the globe from China to the United States of America. Today, he holds the position of country manager for Corporator in Germany, working on scaling Corporator's business in the DACH region with the focus of bridging risk and performance management. Welcome, Carl. And your focus in Germany is so spot on because of things like IDW, PS340, and so many other things I hope to unpack today in our discussion. And then we have Sonka Thun. Sonka is responsible for risk reporting and risk methodology at Deutsche Telekom. He studied business administration at the University of the Federal Armed Forces in Hamburg and has worked as a naval officer. From 2004, he worked as controller at T-Mobile Deutschland, and from 2006 as senior expert in group accounting and controlling at Deutsche Telekom headquarters, interpreting IFRS and assessing the implications for group management. Brad Buckledge has more than 18 years of experience in marketing, sales, and operations with an emphasis on product commercialization and go-to-market strategy, with a knack for market growth and business expansion. Prior to joining Corporator, his career spanned a broad cross-section of national brands, global brand leaders, B2B and B2C. As Vice President of Americas, he is responsible for driving sustainable growth and business expansion of this region. Brad also oversees the global marketing initiatives for corporators. Thank you, every one of you, for joining us.
Thanks for having us.
Oh,
Thanks for having us, Michael.
You're welcome, and I hope to have an exciting discussion building on what Tor and I were just talking about. So I'm going to open it up to you three panelists right from the get-go. What are the best practices in taking a performance view of risk?
So maybe I can start off here. The way I see it is just spinning off what Toringa says about contextualization. Risk management and performance management at the end of the day is about what is important to you and the business. If you are down in the burrows, as you say, Michael, then your job is to manage risks, in the process that you are working with, at the same time as you are actually doing your job, helping moving the company forward. And that's definitely something that we are seeing quite a lot here in Germany, this focus on bridging, as you say, the second line management focus of risk management and getting it down into the first line, into the hands of the people that actually can do something about it. And a lot of times that's, seems revolutionary, but it's really not. And it's just what Toringa is saying. And then Sonka on his profile, everyone is managing risks, whether you're driving your car or you're lifting a box into the van, so maybe actually what risk management is about today is actually bringing it back to what is natural for risk management, as opposed to making it just a management domain and a checkbox exercise. But maybe, and I'm of course just speaking from what we see from the software world, but maybe to make it a bit more practical, I could ask you, Sonka, in terms of bridging this operational risk that you were saying with the strategic one.
Yeah, indeed. I think the main importance of these factors, you have to be close to the business as a risk manager. So we at Deutsche Telekom, we are now part of the risk management team or the risk governance team. We're calling not risk management, but governance, because we don't say we manage every risk. I only manage the risk of my department, not of whole Deutsche Telekom, because, we are an international corporation. There cannot be a department who can manage the risk of Deutsche Telekom. That's not possible. And so we developed this idea of everyone is a risk manager. So to give the responsibility to everyone who's doing business at Deutsche Telekom, and that's at the end, every employee. So that's the first line is clearly in the business and they have to deal with the risks. So we, at our level, look at the connection to performance management. So we are now part of performance management, the team, and we are closely interacting with them. So for us, risk is a deviation from the plan. So it's closely linked to the numbers. So if there is, that's also for the business. So they will see a deviation and then report it to us, and we will get the proper instruments then in place. So that's the whole connection of the process.
Yeah, and if I can add on some of that, what we've been seeing in North America is our clients are going from, if they're starting from a performance perspective, as they've gone through this pandemic, maybe it's operational resiliency, they've realized these risks and the impact they have on the performance. So how do they start taking a deeper dive into risk? Instead of waiting for the risk departments to bring the risk to their attention, how do they align those risks to their strategy or their growth goals? Where are they trying to take the business? These risks are now prevalent. And the other thing, the conversation we constantly have, and Michael, you touched on it a little bit, and Thuringa, you touched on it, was don't make a risk a negative. If you talk to someone who's a mature organization, they don't use a KPI as a weapon. They use it as insight to tell them where they need to go and how to monitor how they're doing. Don't use a KRI in a negative light. What's the positivity that's come from that KRI? How are we managing that risk, and what's it telling us? And how do we take that risk and what it's telling us and tie it to the performance or the strategy where we're trying to go? So that's how I'm starting to see the performance view on risk here in North America.
Yeah, a little side question here. So like last year, 2020, I had several interactions with people on your team in response to IDW PS340. How's that impacted Deutsche Telekom? In your whole perspective on risk, does it change it, or is it just sort of facilitates what you're already trying to achieve? And maybe for our audience, even just sort of give a summary of what IDW PS340 is.
Yeah, I think that changed a bit the perspective on the whole risk management approach. So, this new standard is the regulation for our external auditors, how they look at us once a year. And it's about the rules of how we have to do risk management in Germany. And one of the major requirements is to have a kind of aggregation of the risk. So if you look at aggregation of the risk, how you can do that. In theory, you can do it qualitative, but you don't know how, or quantitative, meaning you have to quantify a risk, then do a kind of aggregation, as best with a Monte Carlo simulation, and then come to a value at risk, and compare this to KPIs. So to things, we call it a risk bearing concept. So we have 3 KPIs which compare these values to see is there a possible danger for the company or not. So there is a close link to the performance team and to the numbers of the company. And that's really new, to have really a KPI set to really measure against. And that's the whole idea of this new German standard. And that was really not so easy to do. And you need powerful technology behind that.
Yeah, thank you for that perspective. So let's use that and leverage that for our next question here, because it gets into the risk normalization, risk aggregation, and overall reporting and quantification of risk. But how do we enable risk intelligent decision-making and business planning?
I think you have to communicate a lot. So for us, we're looking at the strategy, and we see which risk derive on the general perspective, even with a long term. So this is the first point. Then in the planning process, so everyone is looking at the risk landscape we currently face, or we currently have to see what's going on there to enable fair discussion and to bring every needed information at the table. So I think you have to be close to business. So risk management is also about walking around and talking a lot. It's about communication, because otherwise you don't get the message to everyone. So everyone has to know that there is information regarding risks. And most of them knew that by themselves, because their daily business to deal with the risks. But there are also risks from outside which they might not know, and this has to be communicated to everyone so that it's clear.
Yeah, and just to add some things that that we see, making risk intelligent decisions has been something I think we've done for many, many years. Probably the industry that is most commonly using risks to make decisions is maybe finance. Everyone that is planning investments, looking at cash flow analysis, thinking about what can go wrong, what can happen, but of course, what are the benefits towards the end of the day? That's very much a risk intelligent decision. And what we are seeing now, at least from our perspective as a software vendor, is that using and leveraging technology, you can now get more information from your risk profile, your risk exposure, into that business planning to make better decisions. Like, for instance, with this IDW standard now dictating a lot of quantification of risks, following value at risk to make decisions for future planning. And I think if I remember correctly, Sunke, from your side, it's 1 to 2 years in the future that you are looking at for your risk picture. And do you bring that up to the board or to the finance for their planning? Or?
Yeah, to everyone. It's to the board, it's to the finance community, to all CFOs of all subsidiaries, and at the end also to the supervisory board. Yes. So we look at this that there is a difference. So we have this short-term perspective from the next 2 years, because that's the same for external reporting for the prognosis. And then we have also long-term view to see. So what is the dark things maybe looking at the past? So maybe the climate change, for example. This is also part of our discussion, but this is very difficult to quantify. So we have also different perspectives. So how we deal with different kind of risks.
This is a fascinating discussion. We often hear the term people, process, and technology. I find that my risk conversations in Europe are more mature than I have in the United States. And I'm generalizing. I mean, there's some great risk programs here in the US, but so often risk management is seen as a checkbox exercise in the United States, a compliance exercise, and not really integrated into business processes and performance. In fact, when we look at people, process, and technology, I get frustrated because people sometimes focus on the technology aspect and think that technology is going to solve all their risk management problems and forget about the people and process piece. And one of the interesting things about corporators being able to bring in that process focus and strategy and performance focus to bring balance to that, just because it's not just about buying technology, it's about making it a part of the business itself and part of the culture. And so far, this discussion sort of reminded me on people, process, technology, and how some organizations err because they think that risk management is about buying a technology out there and they forget about the people and process side of it, which is so important. So, how do we move this then to also not just people, process, and technology, but governance and the role of the board? How important is risk management today to the board, and what are the trends you are seeing in this?
Yeah, maybe I can say something for Germany. So at the end in Germany, by law, we have to have risk management in place. So there is the German corporate law forces the board of management to have a efficient risk management system, whatever efficient means. But at the end, this is the demand. And so everyone of the board is keen to have a functional risk management system and to protect themselves and also the organization for the future. Because if you don't do this, you might end very fast, or the company might end very fast. So it's in their own best interest and the best interest of the company to have a proper risk management system in place. So, and there is really no discussion about that.
Yeah, Michael, if I can add a little bit from a North American perspective, I think you're correct, right? Risk from in North America has always been a checkbox, if you will, right? It lived in a silo. We're doing our risk management. We're doing the best we can. And then you have performance and strategy, the reality is in North America, most places around the world, boards interested in performance. What's the value? Is our shareholder value going up? Are we achieving financial goals, sales goals, whatever it may be, whatever the metric is? And risk was an add-on, if you will, at times on that board report. Okay, we're mitigating our risks. Everything looks great. Everything's wonderful. Oh, we should watch this one. But I wouldn't say COVID brought that to light, but what we're starting to see more and more, and I'm seeing it with consulting groups and with direct customers, is they're identifying those risks now. And they're trying to tie those risks back to their performance, and they're keeping an eye on it. They're wanting to know more and more. What is this risk here? What is this happening? How are we going to mitigate this risk? And how is this risk impacting our performance? And we're starting to have, even though we do not have IDW, we are starting to see more and more people trying to take that pathway down to quantifying that risk. What's the value impact on that risk is giving us? So that's, from a North American perspective, we're migrating in that direction as well.
Tor, I'm going to bring this back to our previous discussion, the fireside chat. Based on the questions we've had so far for our panel, and what are the best practices in taking a performance view of risk, and how do we enable risk intelligent decision and business planning, and how important is risk management today at the board? What are some of your thoughts on this and perspectives that build on what we were discussing in the previous half hour?
No, as I said, it depends on the board, of course, but we just see more and more, when we live in these agile times where one airline company can do fantastic, the other day it's almost broke. When tech companies are doing very good, and then it's a problem with some IT security or whatever, then you're out of business the next day. So I think board and top management are very aware of the changing circumstances that we live in. We live in a hyper agile kind of environment, and it's getting more regulated. So when we get more trouble, technology is doing more good things for us, but it's also making us more regulated. And I just see that the boards, they like to make sure that we are compliant with laws, rules, and regulations. That we manage our risk. There is always a question around cash flow, prognosis, etc. And these questions are also, have we thought about the risk? What are the downside? What are the upside? What if there is a black swan scenario? It's there. It's ingrained in the business. We say decision-making environment. That's what we see. So as important as performance has been and was and has been in the past and is today, we just see that risk and compliance is just booming up to boards and executives, and it's all around making these decisions with those aspects as well.
It's becoming a popular steering tool for companies.
Yeah. So when we, Michael, when we are approached now, it's not we would like to have a strategy management, strategy execution, performance management system. I think in 8 out of 10 cases, it's also embedded with risk management.
That's great to hear, and I hope to see even more of that happening.
Yeah.
Now I've got some more questions of my own, but we have some great questions incoming from our audience today. This question is directed specifically to Soinka. How do you help your teams understand their risks holistically and comprehensively? Different types of risks, information risk, regulatory, financial. So how do you help your teams understand their risks holistically and comprehensively? And what are some how-to best practices in alignment with strategy? Or how to best prioritize it in alignment with strategy?
I think you're on mute, Sonke.
I think that's a very good question. It's a complex one. I can talk maybe 2 hours about this, but maybe I'll try to make it short. So, clearly we have some categories regarding risks, but so our risk process is totally linked to performance. So that means we have clear goals, performance goals, and if there is a deviation from our goals or for the plan, then this is for us a risk. And this close linked help the business side say, okay, I have a risk, I fear risk because I will be not able to meet my target. And then they will start to report it or to work against it. So then they look at mitigation measures. Clearly, the first idea is to do it by themselves. Or then if they say, okay, it won't work on my cell level, I will put it the level up. And so it goes to every hierarchy levels up to the group level. So that's the first point. That's the bottom-up way. They look at their performance measures, they compare it and bring the measures up. From what we're doing from the group perspective, we look at the overall perspective in the world. So we look what is going on around us. So we're doing a discussion with our strategy team to say, okay, we're doing every quarter a PESTEL, so political, economical, social, technology, and the stuff. We look at this and see, so what is affecting us? It might not be a risk directly targeted at us, but it might be for us of importance. For example, there might be a conflict China-Taiwan that is not directly on the page, and it's not directly a risk for us which we can quantify, but it's on our page. And so we signal this to our teams, say, look out, so that might happen, and what could it mean for you? So that's on both sides, we look at from retrograde, bottom up and top down to get every information in place. I hope that fits somehow to the question because it's a rather complex one.
It addresses it directly. Any other thoughts from the corporator guests? Okay, so the next question we have from our audience Most organizations have struggled in the pandemic. Any evidence of firms who align risk and performance doing better, even prospering over the past 18 months? Or is it all just about luck, like Zoom being in the right place at the right time?
I think there's quite a lot of evidence that companies that are focused on this are doing well. What did I see just yesterday? Post on LinkedIn from the chairman of Volkswagen, and they called in Elon Musk and they gave him the kudos, oh, you did so well, Tesla did so well during the pandemic. And it's all because they managed to plan their shortage of the chips, the electronic chips. They made their own software, they made their own plans in beforehand, they made their risk assessments, and then they went through with it way before any pandemic hit. But when the pandemic hits, they can now produce items and use equipment that the rest of the market is really struggling finding. And this is, a direct link. They want to sell more cars, so they have they figure out what can go wrong with their supply chain. They fix some really major issues, and now they're doing better. And even Volkswagen is calling them in on their board meeting. So it's pretty funny.
Tor, Brad, do you have any other thoughts on that?
Yeah, I think also Corporator was prepared for this. We are not a Zoom company like having online meetings, but I think in general, tech companies have been kind of had the luck of not being. You had to be in one place producing physical goods, etc. But it's about being agile. So I think. Keeping control over cost, the whole exposure, what happens if we don't sell anything, So I think we were prepared. We have grown 30 to 40% over both in 2020 and 2021. So, and I think that has to do with how we are structured as a company and how we have taken this risk prevention kind of make sure that whatever happens, or at least the things that we can foresee, we kind of have a very good control over cost, income, people, etc. So yeah, I won't say that Corporator could foresee the whole pandemic, but I think tech companies in general have been very fortunate, of being tech companies. But I agree with you, Carl. I also read the story about Elon Musk, and he just didn't sit and wait. That's what a lot of car companies are doing. They just sit and wait for the right chips. Instead, he just go and reprogram the software so we can use some of these other. It's a great thing, Nothing's gonna stop us now. There is a song that is like this, and I just see it looks like Elon Musk has this kind of whatever hindrance me, I'm overcoming it. I'm moving forward, And whether he had a plan, or at least he is actually executing on it when it comes up. It's not like you always need to foresee things, but he is agile enough and make sure that he do the right things.
Another audience question that came in, and again, it directed to Soinka. What GRC platforms, software, otherwise risk technology, does Deutsche Telekom use? And I would add to that, what made that software stand out? Why did you choose that one?
Yeah, also, clearly we are using Corporator, and can I tell you so why this is the case? So last year we did a kind of we asked 29 companies all over the world to give us an offer. So regarding our demands, so we had a special demands what we need. So also regarding the German regulation, quantification, we talked about Monte Carlo simulation, that was clear and needed. And from these 29 companies, we got answers from 15 companies. And of those 15, we asked 5 in a kind of beauty contest to perform in front of us to see what they can deliver. And at the end, the best user experience and the best match to us was Corporator. So that is the reason why we chose Corporator at the end, and we are quite happy with that.
Excellent. And I had several interactions with your team during that process here and there. So, and some very clear thinking on what you're trying to achieve and bring risk into the organization from more of an operational point of view, and address things like IDW PS340, which gets to this next question I have. What is the role of operational management in aligning risk and performance management? And so, I mean, obviously technology enables that engagement with what we call the first line, being operational management. So, but what is the role of operational management in aligning risk and performance management? Because we've talked a lot about that board of directors and that governance of risk at the top, but now let's get down to operational management. Who'd like to lead with that answer?
I'll start this one off, Michael. My perspective, what I see when working with clients and partners is, and to use your example earlier of the fire, this is the fire department. This is where the two worlds collide from what I see. The KPIs come down to them, the KRIs come up to them, and they're managing both. They are the point that's trying to integrate those case in case again, client after client. They are the front line. They are that fire department that is managing both sides of that fire, is what we see.
Maybe I can add to this. So as Tor English just said, so everyone is a risk manager. So that's our general idea. So it is for us. So that the first idea to deal with risks should be the business who know about the risk and to know how to deal with this. Because there cannot be a central unit to do that because they know best what to do. So that's for us the point, and they know also what they have to achieve. So there is this clear linkage, and it fits.
So Sonke, if I can steal your kind of everyone is a risk manager and say everyone is a performance manager. You know, it's all about performance management. It's about to perform. It's just another kind of fragrance or dimension to this. And of course, operational performance management is also important. You know, how fast can you run your operations, how efficient, how cost efficient, etc., how safe, all these kind of dimensions. So you use performance management on the operational side as well as you do with risk management, and it all fits together the same way as it does on the top. Yeah.
And I guess a good point also with risk management. At the end of the day, you have to manage the risk. You can report it as much as you want in a board level report, but someone needs to do something about it if it's a big risk.
And ultimately, to do something about it means you have to have accountability. And so there's a great place for risk accountability here for operational management, which is different from responsibilities. Because if we don't really assign accountability, then responsibilities can be passed around like a hot potato. And so in that context, nobody's truly accountable because they'll say, "Oh, somebody else gave that to, or somebody else." How do we really manage risk accountability at operational management?
Yeah, I think that's really the question is quite good, and we are heavily working on that. So we are running a lot of campaigns really currently. We train as much people as possible and do some teachers in from. We have messages from the top, so tone from the top, from the CFO to really get this message. So to have a risk, there's nothing wrong with this. So you can have a risk, and that's not bad. So you just have to work on this, and if this is too big, just report it. So it is really. It's a lot of this communication stuff again.
So we've had a lot of discussions here across a range of themes, and risk management is about governance from the board down. It's about engagement of the front office, operational management. It is about process, but there is a role for technology to really enable this. We don't want to put the cart before the horse and start with technology and then figure all the other pieces out, because risk culture, governance, process is all critically important to understand how we're going to use technology. But the question now, as we end our session, what is the role of technology in integrating risk and performance management?
If I can start off this one, it's bringing all of these things together. At the end of the day, if the technology works really well, you can have people managing risks and spend less time on assessing risk and reporting risk. Let a machine do a machine work, or the same with performance. Spend more time on managing performance, running your projects, talking with the right people, instead of spending time on, either paper or in digitized versions of these methods like Excel and email. So technology, and also like Corporator, enables this view where you have, as you mentioned, Michael, the people and the process focus, but the technology just makes that piece work.
I also see, Michael, you kind of have two ways of solving the technology piece. And I agree. I rather do risk management, performance management very well, executed very well without technology than having a technology and you don't get any benefits out of it. But what I see is that project managers, PMO, project management office, they deal with risk management. And then the financial people will deal with this. Strategy people deal with this, etc. So the question is, do we all have kind of subsystem for managing all these risks in all these kind of subsystems? Or is there a place where we can describe the whole business management, that is taking place, like a digital twin of an organization, as Gartner mentioned, So my question is there a way to have a central place where you can actually work risk-wise, performance-wise, strategy-wise, and all the business domains together? Well, go for it. I think that's kind of a best practice instead of having 20 different subsystems where you kind of manage your risk. That's kind of one of the kind of the key things that we are focusing on our business management system.
Any other concluding thoughts before we move on to our GRC in the news? Well, I want to thank each of you of our panelists for joining today. It's been a pleasure and very insightful working with each and every one of you on this and hearing your perspectives. Stay with us for the next 30 minutes. I will be reporting on the biggest news stories within GRC. Welcome back to the GRC Red Flag Series. This is GRC in the News, where I go through the GRC report, my weekly email on news impacting governance, risk, and compliance over the last several weeks. I want to thank you again, our sponsor for this month's GRC Red Flag Series, Corporator. And Corporator it sponsors this series. And we want to thank them for that. So first off, I want to give you some of my thoughts on governance, risk, and compliance from a European perspective. I spent the last 2 weeks on some recent travels going across London, Paris, Copenhagen, and Zurich. And I interacted with over 100 different companies in my workshops, one-on-one meetings, and other presentations. Over 200 individuals, but over 100 companies, and had some great conversations. And some of the lessons learned I want to share before we get into the news. First off is risk management maturity. Risk management maturity, I find to be that I have more intelligent discussions of risk management in the United Kingdom and Europe than I do in North America generally. In the USA, risk management is too often a compliance checkbox exercise. In the United Kingdom and Europe, it is more integrated into business strategy and processes from my perspective. Now, I have great conversations with some organizations in the United States. I'm not saying every organization is doing risk management badly in North America. I just find in general, I have more mature, strategically aligned risk management discussions like we just discussed with Soinka from Deutsche Telekom. Specifically, there's more level of maturity in those interactions with European organizations that I find generally in North America. The next one is compliance management. Even compliance in the United Kingdom and Europe requires a risk-based approach. What we find in the EU Better Regulatory Policy, which was initiated originally from the United Kingdom's FSA before it became the FCA nearly 20 years back, is focused on principles and outcomes instead of checkboxes. This requires a risk-based approach to compliance management as the focus is on the outcome and not necessarily how you get to the outcome. In the United States, we find a focus on checking checkboxes of compliance and then the firm wanting a get-out-of-jail-free card if they check all the checkboxes properly. And so in the US, it's very prescriptive. Well, in the United Kingdom and Europe, compliance is often unprescriptive and focused on the outcomes, which requires more of a risk-based approach. The third thing that really struck me is business process modeling in GRC. I love the RFPs I interact with in Europe because there's a majority of them want business process modeling capabilities in their GRC platform. The focus is on business processes and business process modeling to become an essential component of second and third line GRC functions and to enable the first line. And we just discussed this with our interview with Corporator and Deutsche Telekom in the previous segment. The foundation for things like GDPR compliance, as well as other privacy regulations, is data flow diagrams on how personal data is collected and used in the organization. The operational resiliency regulations in the United Kingdom and Europe require really center on documenting processes and services and defining impact tolerances. The United Kingdom senior managers and certification regime and accountability regulation requires responsibility maps, which is again about modeling and mapping. But if I had to add a fourth theme to this list, it would be ESG, and it should be on this list. Environmental social governance, I had so many interactions on over the last 2 weeks in Europe. And what is really interesting is about 1/3 of RFPs for governance, risk, and compliance, risk management technology are including ESG requirements. And the focus I hear over and over again now is that organizations don't want a separate ESG solution. They want their existing governance, risk, and compliance solutions to deliver ESG for them. But now on to the news. As we do every month, we segment the news by role. And a lot of these news stories I can define in multiple roles, so I try to focus on what role does it fit in best. And the first role we look at is compliance and ethics. The first news item to look at is NatWest pleads guilty to anti-money laundering charges. A subsidiary of NatWest Group PLC pleaded guilty in the United Kingdom on Thursday to charges that it violated regulations requiring financial institutions to maintain adequate anti-money laundering systems and controls. The guilty plea is the first criminal prosecution under money laundering regulations that went into effect in 2007, the UK's FCA reported. Next, the Justice Department here in the United States to redouble efforts in combating white-collar crime. A senior Justice Department official gave a first glimpse into the Biden administration's approach to white-collar crime, saying the agency would commit new resources and tools to weeding out wrongdoing by companies and their executives that harm U.S. national security. Then, an absolutely critical one, employee engagement is crucial in weeding out corporate misdeeds. Employee engagement is seen by compliance professionals as instrumental in uncovering potential crimes within companies, said Glenn Leon, Senior Vice President and Chief Ethics and Compliance Officer at Hewlett-Packard. During the coronavirus pandemic, Mr. Leon initially saw a decline in incoming complaints and inquiries from employees. Although he isn't sure of the precise reason behind the decline, his working theory is that people aren't in the office as much engaging with managers face-to-face, and they may be seeking external resources to report on. One of the things to think of as we can maintain and continue a hybrid environment is how do we include and continue employee engagement to monitor and look for corporate misdeeds and wrongdoing. Former Braskem CEO sentenced for bribery charges in the United States. The former chief executive officer of Brazilian petrochemical company Braskem has been sentenced to 20 months in prison for his role in a scheme that diverted $250 million from the company to a slush fund to pay Brazilian government officials, the U.S. Department of Justice said. Tuesday's sentencing of Jose Carlos, a Brazilian citizen, at the federal court in Brooklyn, New York, comes after his guilty plea in April. He pleaded guilty to one count of conspiring to violate the anti-bribery provisions of the U.S. FCPA. The CFTC's $200 million whistleblower award. Here's news that will leave whistleblowers speechless. The Commodities and Futures Trading Commission just gave out the largest whistleblower award in U.S. history, a $200 million windfall reportedly going to a former Deutsche Bank executive who provided crucial help in unraveling the LIBOR rate fixing scandal. The CFTC won't confirm the whistleblower's identity, but the person was represented by whistleblower attorney David Koval of the law firm Kirby McKerney. Koval wouldn't identify his client by name, but did issue a self-congratulatory statement Thursday. Whistleblowing is a huge focus, not just in the United States, but Europe with the EU's whistleblowing law as well. Pay attention to these. Credit Suisse to pay nearly $475 million to U.S. and U.K. authorities to resolve charges in connection with the Mozambican bond offerings. Credit Suisse has agreed to pay nearly $475 million to US and UK authorities. This includes $100 million to the Securities and Exchange Commission for fraudulently misleading investors and violating the Foreign Corrupt Practices Act, FCPA, in a scheme involving 2 bond offerings and a syndicated loan that raised funds on behalf of state-owned entities in Mozambique. Then individuals regulated by the UK FCA, the Financial Conduct Authority, where is the boundary between private misdeeds and regulatory censure? Criminal offenses, even serious offenses, will not necessarily preclude someone from being approved under the SMCR, UK's Senior Managers and Certification Regime, by the Financial Conduct Authority. Rather, what may determine fitness and propriety is transparency and honesty of the person towards the FCA, particularly in reporting a criminal offense or other misconduct. Then investment firms' prudential regime final rules have been published. We have today made final rules to streamline and simplify the prudential requirements for solo regulated United Kingdom firms authorized under MiFID, Markets and Financial Instruments Directive. This is part of the investment firms prudential regime, a major change to FCA investment firms. If you're an FCA investment firm, it's critical that you prepare for the regime, which comes into force on January 1st, 2022. Next topic is environmental social governance, ESG. Here, boards face growing pressure from ESG petitions. After an unprecedented year of investor support for environmental, social, and governance petitions at companies worldwide, board members are bracing themselves for more pressure in the months ahead. A record 12 proposals on environmental issues filed at U.S. companies in 2021 were passed with a majority of shareholder support, according to law firm Sullivan & Cromwell, which has analyzed voting patterns in annual general meetings. Environmental social governance is all over the place right now. Every day I'm having multiple conversations on ESG. Here it's coming from investors, like BlackRock and State Street and others are making investment decisions based on ESG metrics. But on the flip side, customers are making, who they do business with, decisions on ESG metrics. Employees, particularly Gen Z and millennials, are making employment decisions, not just on salary and benefits, but on the ESG values of the organization. Regulators are picking up on this. You've got to pay attention to ESG. But boards of directors are, just as this article stating, is facing growing pressure from ESG petitions. Next, FSOC report, climate change increasing threat to U.S. financial stability. The FSOC stated climate change's threats to the market are both physical, such as wildfires, raising sea levels, stronger and more powerful storms, and transitional, changes in policy and public sentiment to entities that produce carbon emissions. In a report released, the FSOC urged market participants, public companies, and regulators to develop a common agenda to respond, laying out a suggested course of action that involves assessing and measuring the risks posed by climate change, disclosing those risks, and managing them over the long term. I was just having a conversation in New York City on this topic yesterday, and the whole thing of greenwashing and just understanding some of the downstream impacts of what seems like green isn't always green. But climate change is a big focus. Information security and privacy is our next topic. So first off, Twitch data breach exposes everything. The emperor has no clothes. Source code, confidential company information, and user payouts. Hacker promises more is on the way. A massive data breach of video streaming service Twitch has exposed just about everything possible that could be taken from its internal network. That's one significant compromise in exposure, literally exposure. The 125 gigabit torrent posted on a public website for anyone to download has been confirmed by Twitch and is only the first part of forthcoming materials, according to the anonymous leaker. The data breach appeared as a 125 gigabyte torrent linked posted by popular message board 4chan on Wednesday. Most cloud containers deployed on public registries contain vulnerabilities and misconfigurations that could result in a supply chain attack. Palo Alto Network's Unit 42 team discovered that almost all third-party cloud containers deployed on public clouds have vulnerabilities and misconfigurations that expose organizations to supply chain attacks. According to the Unit 42 Cloud Threat Report, the second half of 2021 reported 96% of third-party containers applications deployed in cloud infrastructure contain known vulnerabilities. And 63% of third-party code templates used in building cloud infrastructures contained insecure configurations. Next, Congress tackles data privacy compliance for fintech. When Democrats and Republicans in Congress agree on an issue, you know the problem must be very serious. In this case, the problem is third-party fintech data sharing. According to Roll Call, the House Financial Technology Task Force held a hearing to discuss whether consumers understand the degree of access they hand over to third-party data aggregators and whether stronger protections are needed. The committee pointed to apps that share sensitive data and then aggregate usernames and passwords to scrape data from the accounts. Thanks to a growing number of data privacy regulations, ranging from HIPAA to GDPR, consumers are increasingly aware of the risks to their personal information and the need to protect it. Irish DPC rankles privacy advocates again with a proposed 42 million GDPR fine for Facebook. Ireland's Data Protection Commission has been investigating Facebook since shortly after the European Union's General Data Protection Regulation went into effect 3 years ago in 2018. During that time, the agency has developed a reputation for the very long investigations that ultimately settle on relatively small fine amounts. That reputation stands to be burnished with its first draft decision against Facebook. The proposed fruits of the Irish Data Protection Commission's 3-year investigation into the social media giants' consent and transparency violations are GDPR fines that would amount to a maximum of about 36 million to 42 million US dollars, or what the company makes roughly every 2 hours. Put that into consideration. Next is the topic of third party and supply chain, one of my favorite topics, and so many things impact this, from compliance and ethics to IT security to the ESG. Everything we talked about already in this GRC in the News segment has a third party supply chain implication, because today's modern business is not defined by brick and mortar walls and traditional employees. The modern organization is the extended enterprise. So let's look at this. First off, managing third party risks. Here's how a holistic approach can help. Recent supply chain attacks compromising multiple large organizations across various industries have had dramatic operational, financial, and reputational consequences. These events don't just affect the victim, but all stakeholders in the value chain, and demonstrate the importance of taking a collaborative and holistic approach when managing third-party risks. Managing third-party risks is challenging owing to the large number of suppliers that organizations have to onboard and manage. Next, why is third-party risk management important? Well, third-party risk management is essential to a company's security. I would say it's even broader. It's essential to the compliance and ethics and ESG and so many other aspects, as it helps to protect the company from the risks that come with its involvement with an outside vendor. By relying on a third party for necessary business products or services, a company may be subject to reputational risks, financial risks, and information risks should a mishap with a third party occur. It is important to vet third parties to determine their trustworthiness. Often, third-party involvement requires the sharing of confidential information between both parties to perform business. Cybersecurity risks can be especially common with third parties among an array of other risks, as they can have access to sensitive information. And then we have supply chain cybersecurity breaches have hit an alarming percentage. A new study shows that supply chain is a magnet for cyber breaches. A whopping 97% of firms have been impacted by a cybersecurity breach in their supply chain. A study by cybersecurity company Blue Voyant said. And 93% admitted that they have suffered a direct cybersecurity breach because of weaknesses in their supply chain. Breaches are still staggeringly high, said Adam Bixler, global head of third-party cyber risk management of Blue Voyant, in a blog post. We need to be able to address the range of third-party risks. It requires that we have a holistic approach to third-party risk in the extended enterprise. Cybersecurity being one element, but the financial viability and stability of the third party, the ESG commitments, the compliance and ethics, dealing with supply chain, vendor code of conduct, Foreign Corrupt Practices Act, and more. The resiliency aspects. There's so many aspects and complexities in third-party risk in the extended enterprise that need to come together here. But with that is GRC in the News today. I'm your host, Michael Rasmussen, for the GRC Red Flag Series. I want to thank you so much for sharing this time with me today, and I look forward to our next episode in November. Stay tuned.